Hello, scholars. Welcome to this unit on risk and return in the security market line. Let me start by remembering one of my favorite quotes. Yes, it's easier to be around like-minded types, but finance recommends the hard work of exposing yourself to differences, not shielding yourself from them. And I loved that quote as a relationship to diversification and this big idea in finance that you get diversification by holding more assets in your portfolio that are different from the ones you already have. And I loved the parallel that we should do this in our own lives as well. So let's take a look. We have three big portions to cover. There's split in three, if you notice. We're going to talk about expected returns and variance and then portfolios. And then in the second part, part B, we're going to talk about announcements, surprises, expected returns, risk in terms of systematic and unsystematic. Then we'll get into diversification and portfolio risk. And then lastly, we'll close with this idea of systematic risk related to variance, the SML, and a little teaser on the cost of capital. So let's start with expected returns and hear it from Buffett himself. Take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That's what we're trying to do. It's imperfect, but that's what it's all about. So our expected return is just the return that we expect on a risky asset in the future. So this expectation of return, that's how you read it. This is just read expectation. That's what the E is. And then the brackets are of, and then the R represents return. So the expectation of return is just the sum of the probabilities times their respective returns in those states. So this is the probability of a state times the expected return on a state. And then you just repeat this for S number of states. And that's exactly consistent with what Buffett said is a probability of a loss times the amount of a loss. And then we add that to the probability of a gain times the amount of a gain. So we could think of PS as also how likely this thing is to happen, and then multiply it by what you get if each thing happens, and then you add those up. So let's take a look with Papa Patel Motel. You're considering investing in a motel. You have run several analyses of your hotel investment and weighed them in accordance to their probabilities. What is your expected return? So we're going to do this equation. The expected return is just the sum of the probabilities of states times the returns in those states. So our first probability is 80% times the return in that state. We'll move the decimal two places. That's 400 plus the next probability of 10% chance of earning 40%. And with our last 10% chance of losing 100%. So again, I'm just moving the decimal twice because these are percentages used in a formula. So if we did that math correctly, our expected return answer will be 314%. That's a phenomenal expected return. So let me ask you this question. If it turns out that the third scenario occurs, a severe recession, so it turns out after we made this investment based on expected return that we lose the investment, we lose 100% of that initial investment. Does this make it a bad investment? And the answer to this is no. And I think that may surprise a few of you. It's not a bad investment. We can't just judge based on outcome. We can't judge an investment based on its outcome, but we should be judging it based on the probabilities. So we don't know the outcome when we make a decision. We only know the probabilities of outcome, or we're only estimating certain probabilities before we invest. Then after we invest, there is some chance of losing money. And let me leave you with this quote. There's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. Just because you made a good choice and it had a bad outcome doesn't mean you shouldn't have done that. For example, we drive our cars every day. It doesn't mean if you get in an accident that it was a bad idea to drive cars. It just means sometimes good decisions have bad outcomes Don't let it weigh you down. Think of investing as an iterative process over and over again. If we're making sound investment decisions, then long term we'll realize great expected returns. And that's how I like to think of investments is sometimes we have good investments with bad outcomes. But long term, if we are making good investment choices using things like probability analyses, and we're understanding the risk that we're getting into with an investment, then long term we'll be fine. And that's the difference between investment and speculation. With investments, we have positive expected returns. With speculation, things like gambling, we have negative expected returns. Most people will lose. So let's take a look at expected returns and introduce this idea of a risk premium. A risk premium is an expected return. So I'll put that notation here, E of R, expected return minus a risk-free rate. Sometimes you see that notated R subscript F, risk-free rate. So suppose you have predicted the following returns for stock C and T in three possible states of the economy. What are the expected returns? If the risk-free rate is 4.15%, what is the risk premium for C and T? So the first thing is to find the expected return. So the expected return on C, I'll put subscript C there, is the probability of a state. So that's 30% times the return in the state, the expected return of 15%, with the probability of the normal recession of 50% times the return if that were to occur, plus a 20% probability of an expected return of 2%. If we did that correctly, we'll get 9.90. That's the expected return for C. So what is the risk premium for C? Well, the risk premium, and I'll put subscript C, is the expected return on C less the risk-free rate, and that is given above. So our expected return is 9.90% less 4.15%. So if we did that correctly, our risk premium on C is 5.75%. So think of the risk-free rate as the return you should expect just for being patient for your money, just taking no risk. You should expect a return of 4.15%. Now, the risk premium, think of that as kind of like the icing on the cake. That's the incentive or the extra expected return you get for bearing something with an uncertain outcome. That's the reward for bearing risk, the expected return. Notice I keep saying expected return. These are not guaranteed returns. This is what we think will happen. We don't know the outcomes. We're just estimating the probabilities. Now, recall in chapter 12, we talked about this idea of variance and standard deviation, but we are using actual data. In chapter 12, we actually assumed that we had a sample. We didn't have, for example, the future returns. We don't know those yet. So when we measured variance and standard deviations, we were using a sample of a population. So in this case, to find the variance, you take the return in a given state less the expected return, the average that is, and then square those differences, add them up, and then divide by n less 1. This is the portion you're doing because it's a sample. You would have divided by n if you had a population of data, but this is a sample of data. So let's think of it as a small penalty that increases the variance because you don't have the full population to observe. So we do that when we're analyzing actual data. And then the standard deviation is just the square root of what you found above would be your standard deviation. So what did these do? Variance and standard deviation are both measures of dispersion. They measure the volatility of asset returns. And then we're going to make this jump here that a greater volatility implies greater uncertainty. And those things will still hold true for chapter 13, but now we're going to look at variance and standard deviation in a slightly different light. Now we're still going to measure how far we are from expectation, square that distance, but now instead of equally weighting it, we're going to weight scenarios by their respective probabilities. So if an outcome is expected with more probability, it'll contribute more towards variance. It'll have a higher probability, therefore it's going to contribute more to our variance. Standard deviation, we're still going to take the square root of our variance to get to standard deviation, but still think of this as variance and standard deviation still measuring volatility of returns, or even thinking of it as a measure of uncertainty. So using unequal probabilities, that's what we're going to do in this part. That's why you see the probability here, and you no longer see divided by n less 1, which was the denominator for the equation above for samples, and that effectively equally weighted the observations. So let's take a look with this example. We have 3 states with 3 probabilities: boom, normal, and recession. Let's look for C. So to calculate the variance of C, this is your notation for variance. It's a sigma squared subscript C for that asset. And we're going to just take the probabilities. It's a 30% probability. And above, we calculated the expected return of 9.90. So we're going to use that here. So we're going to measure how far we are from expectation. I'm going to pull in the next probability here so you can see where all these numbers are coming from. So I'm going to take my probabilities here, and then I'm going to take my expected returns for C here. So 0.15, 0.10, 0.02, less my expected return, which we calculated on the previous page, 0.099, less 0.099, less 0.099. So we're going to take those differences, square them, and then weight them by their probability. So sometimes I like to organize it this way because I find it's much easier for students to see where all the numbers are coming from. We have our probabilities, we have our expected returns for the asset, and we have the expected return in total. So that is the measure of our central tendency, you could think of it as. And so when we look at variance, we're seeing how far we expect an observation to be from expectation. So we do that first, then we square that number, and then we weight it by how probable it is to occur. So improbable things like this 20% one compared to the others will have a lower weight, a lower contribution to variance. Whereas here, the middle 50%, it's very tight, right? We expect a 10% in a normal economy state, but our total expected outcome is 9.9. So that's very close, and that's weighted a lot. So that's gonna really bring variance down. So if we did this correctly, this is your variance, and it would come out just like that on your calculator. Don't play with the units. You could think of this as either a unitless number, but it's really in percent because you took a percentage number inside the brackets, squared it, and now it's percent. So when you take the square root of that answer, then you get to your standard deviation, which is back in the units of input, which in our case was percentage. So that's why you hear standard deviation talked a lot more than variance, is because the units come back out in the units of input. So the way I would calculate this on a financial calculator, I would just take each one at a time. So let's start with the 15% less than 9%, 9% equals, calculate that, and then just square it. There's a x squared button up here, and then multiply that by the probability times spot 3 equals. Instead of writing all this down, I'm going to store that, and there's a store function in our calculator, STO for store, and that's the first number I calculated, so I'm going to press store 1, and I can get that back later. Then I'm going to do the next one, which is 10% less spot 0.099 equals, and then square that distance, and then multiply that by its probability of 50%, and then go store 2. And then I'll do the last one, which is 2% less spot 0.099 equals, square that, multiply it by its probability of 20%, and then add it to recall 1, add recall 2 equals. And there you have your variance. And again, like I said, don't play with the units. That's just your variance. When you take the square root of this number, you're at standard deviation. So all you have to do is press the square root x button, and the units are just like they were as the inputs. We moved the decimal twice on those. So that is 4.50%. And I put a little extra practice in here. Lucky you. See how you do calculating T. And if you make a mistake, usually what I notice is right here, every observation is against the overall expectation. So in our case, we expected for T 17.7. So when we calculate variance, we're just taking what each outcome in the state is expected to be. So the 25, the 20, and the 1 here in this column. And then we're weighting it by the probability 30, 50, 20, 30, 50, 20, and then add all those up. And then when you take the square root of that, you should get 8.63%. So let's now talk about a portfolio. Portfolio is just a group of assets like stocks and bonds held by an investor. And an asset's risk and return are important in how they affect the risk and return of the portfolio. So we have to keep that idea in mind, that is, we care about the risk of the portfolio, not necessarily the risk of any individual asset within it. The risk and return trade-off for a portfolio is measured by expected return and standard deviation, just like we did for those individual assets above. But now we're going to introduce a few more concepts. Let's start with portfolio weights, and that's just a percentage of the portfolio's total value that's invested in a particular asset. So let's look at this $15,000 portfolio. You could calculate that number yourself. You just add all of these up and you'll see it's 15,000. So if you have 2,000 invested in Procter & Gamble, all you need to do is take 2,000 divided by 15,000 and you'll get 13.3% repeating. For Coca-Cola, you take the 3,000 over 15,000 and you'll get 20%. Again, for Microsoft, we'll just do the same process. 4,000 over 15,000 will get you right here, 26.67, which is 6% repeating. And then lastly, we have Tesla at 6,000 over 15,000, which will get you 40%. Sometimes you see a question where you have to calculate the amount invested. So it may give you a price per share and number of shares. So to get to dollars, all you have to do is multiply those, and those two will drop off, the dollar per share and share. When you multiply those, shares drops off and you're left with dollars. So you may have Procter & Gamble at $200 per share times 10 shares equals 2,000, or you may have Coca-Cola at $30 per share and you have 100 shares. So you just multiply those two and so on. So one thing to notice is when you add up all of these weights, the sum will come to 1, which is 100%. So 100% of your portfolio is invested. So the expected return on a portfolio, or E of RP, so this is just, remember, expectation. That's what the E stands for. The brackets are of, and R is return, and the subscript P is for portfolio. So anytime you see this notation, it stands for the expectation of return on the portfolio. It's the weighted average of the expected returns of the respective assets within the portfolio. So I know this notation looks a little intimidating, but let's just take it one piece at a time. You're taking the weight of an individual asset, J, times its expected return, J, and then you're just doing that over and over again for each asset N number of times, adding those up and saying that's my expected return on the portfolio. And we've seen here how we could get to an expected return. You could look at that a couple different ways. You could look at that in terms of actuals, like we did in chapter 12, just taking an arithmetic average of what we've seen in the past. Or we could look at it with a forward-looking view as a probability of what we think could happen under certain states. So this notation, the weight W here is just the percentage of portfolio in that asset. So how much you have invested in that asset, and then you're just multiplying it by the expected return of that asset times what you expect to get from that asset. That's this portion. Let's take a look. What's the expected return on this portfolio? So again, the expected return on the portfolio, E of RP, is just the portfolio weight. So we're going to take this column and then multiply it respectively by this one. So our portfolio weights, I'm going to put here, that's spot 1333 and spot 20 and 0 spot 2667. And I just know these are repeating, 0 spot 40 times the expected return. So I'll put those over here so you can see where they come from. This is spot 01969. This is times 0 spot 0525, and then this is times 0 spot 1665, and then last we have spot 1824. So that would be your expected return on the portfolio. If you did this math correctly, you can double check that you get 15.41%. So that's our expected return on this portfolio if we have these four securities with these weights and those securities have this expected return. If you'd like to do a fun little question here, think about the expected return you'd get on the roll of a dice. A single dice has a cube, has six sides. So what would your expected return be? Think of this question in this context. We could observe what we would get every time we roll a dice. So we could just know all the observations. So observation 1, 2, 3, and we repeat this many, many times, let's say 500 or 5,000 times. If this is our n number of observations, and then this is our outcome, sometimes we'll get a 6 or a 3 or a 2 or a 4 or a 1. And so all we have to do is we could sum this entire column, divide by n. And what you'll notice is if this is a fair dice that doesn't change while you roll it, the expected return would be you'd get a lot of ones and a lot of twos and a lot of threes and a lot of fours and a lot of fives and a lot of sixes in equal proportion. Over 6, you'd actually get the expected return on the roll of a dice to be 3.5. It's an important life lesson in there somewhere. I'm sure that you don't always get what you expect. This is just the long-term average, just meaning if we added up all of the possible outcomes, then divided by how many observations we had, the expected return on a roll of a dice is actually 3.5. You never actually can roll a 3.5, of course, but that's an interesting question. I always thought it'd be clever to ask that in an interview. Let's take a look at portfolio variance, and let me just show you with an example because I think it's a lot more straightforward if we just look at the example versus going through the notation. So focus here on what was given. We have three states of the economy that could happen, and they're associated with certain probabilities. So if state 1 occurs, it has a 20% probability, state 2 has a 50% probability, and state 3 has a 30% probability. And we have four stocks here, cleverly named stock W, X, Y, and Z, and we have their weights. So we have 30% of our portfolio invested in W, 10% invested in X, 20% invested in Y, 40% invested in Z. So we're trying to understand the portfolio's expected return and then the portfolio's variance and standard deviation. So the first step in this is to compute the portfolio's return. Before we do that, we have to calculate the expected return if that state were to occur. So I'll just put the notation up here. The return if state 1, return in state 1. I'll put R1. So if R1 occurs, then stock W will have a 5% loss. So we'll just take 5% loss times its weight of 30%. So we're just going to take this and this, and then 0% return at a 10% weight. So plus 0. That's 10% times 20. Spot 2. That's a spot in front of that one. And then a 30% at 40. So all I'm taking is the return in that state times the weight in that stock. So I'm looking at stock W and saying, hey, if state 1 is occurring, what would the portfolio return? Well, 30% of my portfolio would lose 5, 10% of my portfolio would earn 0, 20% of my portfolio would earn 20, and 40% would earn 30. So let's take a look at the next row. If state 2 were to occur, what would the return be? Well, all we need to do is take 30% weight. So again, that 30% is going to stay the same. So it's going to be the weight will stay the same out here. And we're just going to multiply it by each stock's return. So if 30% of the portfolio, that will return 15, and then we'll add 10% of our portfolio in stock X that will return 10, and then 20% of our portfolio will earn 8, and 40% of our portfolio will return 6. And so lastly, I'll just fill this out. I have the weights there already, so it'll just be 30%, 10%, 20%, and 40%. So we'll take the 35. And if we did this correctly, your return for that first state is going to total 14.5. So if we just get rid of all of these, if we erase all of these because we need some room, we'll see the return, the expected return here being 14.5 if state 1 occurs. There you go. Hopefully you can see that. And then if state 2 occurs, 9.5. I try to be very careful with the colors here in case you can see those. And then 8.5. So again, you should see the weights and here of the securities. We got those under the weights portion, and then the returns were just carefully determined across each state. So now we can think of ignoring these for now. And now we're going to calculate the expected return on the portfolio. So all we need to use is the probabilities here and multiply those by the returns if those states occur. So out here. If you know Excel, that would be your sum product. So you take your expected probabilities, those weights, times the return. So one way you could think of this is just, if you're doing this on scrap paper, it may be easier to look at it like this, times 0 spot. If you convert these all to percentage forms, then you would just have 145 times 20%, and then you would add that to the next one, which is 0.95 times 50% probability, and then add that to 8.5% times 30%. And when you do that, you're calculating the expected return on the portfolio. So that's going to be your measure of your central tendency there. 10.2% is your expected return on the portfolio when you have 4 stocks weighted differently according to these proportions, and an estimate on the probabilities of 3 different states of the economy that could occur. So we think 10.2%, that's our measure of central tendency. So our variance is going to measure against that number. So we're going to take the numbers we calculated above, the 14.5. Remember that first row of calculation we did? And we're going to measure how far that is from what we expect of 10.2, square that distance, and then weight it by its probability. Then we do the next one. Then we take the 9.5%, again, versus expectation, how far you are from expectation, square that distance, and then weight it by probability, and then do it for the next one. The 8.5%, if that state were to occur, how far is that from our expectation? Square that distance and weight it by how likely that outcome is. When you do that and you add all those proportions up, you get to your variance. And again, just be careful with the units. You could think of that as in percent. So when you take the square root of a percent, your units are back into a percent. So your variance is 2.19%. And just to give you an idea, why are we doing this? What does that measure even mean? Well, if you think about it in terms of a normal distribution, if you're calculating the expected return, that is your central measure of central tendency. That's your expected return on the portfolio. And now we expect that 68% of the time, we think that we will observe a return plus or minus one standard deviation from expectation. So it's your expected return on the portfolio plus or minus one standard deviation or one sigma, which is just 0.219. And that's very, very low. If you're not sure, that's an extremely low number. If you were to take, well, let's take a look and let's compare it to what the variances are of or what the standard deviations are of each asset individually. So if you were to calculate what stock W would do, your stock W has an expected return of 17%. And hopefully at this point, you would know how to do that. You would just take the probability times 5, -5, the probability times the 15, the 30% times the 35 to get the expected return, and then variance like we did earlier in the unit. So its standard deviation would be 14%. The standard deviation on X would be 7%. The standard deviation on Y is 693%, and the standard deviation on Z is 1386%. But the standard deviation, when you hold all of these different assets in a portfolio, you have diversification. Your expected return on the portfolio is still really, really good. You're not sacrificing much there, but you are saving a lot in terms of uncertainty, in terms of standard deviation. These returns are now going to be much closer together. And why does that hold? Well, let's take a look. If state one were to occur, stock Z performs extremely well and it offsets W's loss. If state three were to occur, stock W does really, really well and offsets Z's loss. So those are two very, very diversifying assets that are going to contribute well. Those are very different assets. Then that's what you're looking for in a portfolio. You're looking for low correlation and low covariance between assets. So it's maybe tricky to see that just by looking at the chart, but just try to think about it. If state one occurs, W loses, and Z and Y do quite well. But if three occurs, if Z loses, it's offset significantly by W and X. And it looks like if two occurs, they're all going to do fairly well. So that's the principle behind it. It's a little tricky to see, but the reason that's working is these assets are different. And again, that's the key. You can't diversify unless the assets behave differently, unless they are different assets. And the key is low correlation and low covariance between the assets. That's the power of diversification. So let's continue talking about it. In terms of expected return, again, you're not guaranteed returns. Let's dissect this. Your total return could have two components. It's the expected piece, what we anticipated, plus an unexpected return. We'll call that U. And let's talk about announcements. This could be press releases, earnings, 8Ks, 10Ks, 13Fs, any number of things. And announcements and news have an expected component and then a surprise piece. If the surprise piece is affecting the stock's price, and it'll therefore expect will affect the return. The surprise is very obvious when we watch how stock prices move when an unexpected announcement is made. The point is when news hits, it's usually quick, it's unexpected, and it'll impact stock price almost immediately. So an announcement has a piece that's expected plus an unexpected piece, a surprise piece. So if you think of efficient markets, we have a very competitive field here in finance. And if people have new news to process, then investors are rapidly going to trade on this news until the information is said to be priced in. So if any news occurs, the definition of news is that it is new, then the prices should be random because we don't know what news will be. That's the only piece that should move a stock's price. Anything else was expected and that should already have been priced in. And since you can't predict the surprise news, that's what should drive random prices. And you often hear this idea of a random walk. So the return on a stock has two parts that we talked about. It has the expected part and then U, and then we can double click into U, this unexpected return, and allocate part of it to a systematic portion and then part of it to an unsystematic portion. Let's talk about the two kinds of risk. the systematic risk and the unsystematic risk. There are two kinds of risk in this world. Systematic risk, unsystematic risk. Systematic risk impacts a large number of assets. Think of something like COVID. That impacted a lot of securities having this. So the risk factors affect a large number of assets: GDP, inflation, interest rates. You may hear systematic risk called other things like market risk or non-diversifiable risk. Make sure you know those synonyms for this systematic risk idea. You can't diversify all of the risk. Unsystematic risk, or what we call unique risk, firm-specific risk, idiosyncratic risk, or diversifiable risk, affects just a small number or even a single asset. They're independent risks. They're very limited. You can diversify away unsystematic risk. That's why it's called diversifiable risk. You can eliminate this by holding a large number of assets in your portfolio that are unrelated to each other. So it's very common to hear these words in finance. So please study these ideas. It is a very big idea in finance that will be reoccurring, and make sure you know the synonyms for systematic risk are market risk and non-diversifiable risk. For unsystematic risk or non-systematic risk, think of it as unique risk, unique to a firm or an industry. It's firm specific risk, idiosyncratic risk, or diversifiable risk. If you have trouble remembering this word idiosyncratic, just look at the I's. I for individuals, individual risk, individual, firm specific risk. So the principle of diversification is this idea that spreading an investment across a number of assets, a portfolio that is, will eliminate some, but not all risk. You can eliminate what risk here? Well, you can eliminate the diversifiable risk, the unique firm-specific, idiosyncratic, unsystematic risk. But you cannot diversify the systematic risk. So unsystematic risk is essentially eliminated by diversification. So if you hold a portfolio with many assets, it has virtually no unsystematic risk. So if you think of a portfolio here just invested in A and B, and just for simplicity's sake, the portfolio has an expected return or reward on this axis, your y-axis, and it has a standard deviation measured on your x-axis. A and B's expected return will just be across this dotted line. If you hold 50% of your assets in A and 50% in B, remember the expected return on a portfolio is just the weights times the expected return of the assets. So that would just be 50% times A, which would be 5%, with 50% on B. Which would have a 15% return. So your portfolio's expected return would be 10%. That would be right here. What's interesting about this is if these assets are different from each other, which means they have low correlation or low covariance with each other, then the frontier could actually be somewhere like this, which means its expected return is still a weighted average of the weights that you hold in proportion of each security, but that's not true with the standard deviation. The standard deviation could be lower than either of the assets individually, maybe something like 7%. So where do you want to live on this graph? If you could pick anywhere to live, well, you'd like to live way up here, what we call the northwest quadrant, with high expected returns and no risk. So we're trying to move into this direction. And the way to get there is to find assets that have low correlation with each other. So think of this as not just a straight line where your risk is just a weighted average of the two. It could be lower than the two. And if those assets are more and more different from each other, then this frontier shifts outward and outward more and more. So a portfolio stock in A and B have an expected return that's just a weighted average of those two according to their weight. So you could shift if you are all in B, your expected return would be 15. If you're all in A, your expected return would be 5. And if you're 50-50, like we talked about, you're at 10. But the portfolio sigma or standard deviation will be less than a weighted average of these two. And that's a really, really cool principle. This is one of the big ideas in finance. So your total risk, think of it as just a reminder, is systematic and unsystematic risk. The standard deviation measures total risk. That includes systematic risk and diversifiable risk, or unique unsystematic risk, idiosyncratic risk. If you hold a lot of assets in your portfolio, a well-diversified portfolio, that is essentially equivalent to just owning systematic risk. So diversification can substantially reduce variability or uncertainty of returns without an equivalent reduction in expected returns. So you're not sacrificing much. So that leads me to this common phrase that you may have heard in economics is, let me give you a couple hints here. Hopefully you got it. If not, take a second. There is no such thing as a free lunch. I would argue that diversification is a free lunch. So take advantage of it. Spreading your assets, spreading your portfolio across a large number of assets does reduce risk. And it's, if you ever hear of people recommending indexing or holding an index portfolio, essentially they're just recommending diversification at low cost, bought over time, held for large number of years. It's based on this idea that we should be diversified. So we saw this earlier, but I'll restate it again. The reduction in risk occurs because worse than expected returns from one asset are offset by better than expected returns from another asset. We saw that up above. Let me just remind you. So W's worse than expected returns, because it had an expected return of 17, was offset by better than expected returns from Z. And likewise, when Z had worse than expected returns of loss of 10, W was offset. And that occurs because those assets are different. They move in different directions based on different elements. So there is a minimum level of risk that you cannot diversify away, non-diversifiable risk, that is systematic risk. And it leads you to that. Don't put your eggs in one basket. So how many baskets do you need? Take a look. The average standard deviation is 49% for one asset. That is a lot. Holding two will reduce it quite a bit. Holding something around 20 gets you a really good basket. But there, after that, the diversification benefits are reduced, but they are still there. I wouldn't say the diversification benefits don't matter anymore, because they do. Holding a basket of 500, maybe something like the S&P 500, you have a really good diversification, even more than just holding 20. But you can see going from 1 to 20 has a huge benefit. Going from 20 to 500 still has some benefit. And then I think what would happen if you held something like bonds in there, it's going to dramatically reduce your expected return depending on the kind of bonds you hold, but it would reduce your risk. And if you wanted to reduce your risk from the S&P 500, you could consider investing in more international stocks or even small cap stocks, because the S&P is a large cap. So here's another view at this very, very crucial graph that we see in finance, and that's the average annual standard deviation. It's just that chart now in graph form. Was the 49% if you own one security, that's your average annual standard deviation. If you hold something like 20 or 30, notice the risk is going down as you own more and more stocks in your portfolio. So that's a key idea, that owning more stocks in your portfolio will reduce the overall uncertainty or the standard deviation. There is a point at which it levels out. There's a limit that you cannot get rid of, and this is the systematic portion. That's the non-diversifiable risk. So for a well-diversified portfolio, maybe the S&P 500, unsystematic risk is very low. You're out here at like something like 500. So very, very low. What you see is just a measure of systematic risk here, and you have essentially eliminated this portion of idiosyncratic risk. It's very small, close to zero. In large portfolios, all the firm-specific risk is diversified away, and you're left with market risk. So that will lead us from this idea of standard deviation as a measure of risk into a different measure of risk called beta. So standard deviation, remember, measures total risk. What we just said is, hey, for free, essentially, just by owning more assets, standard deviation can be reduced. You can get rid of a portion of this total risk. And the portion you can get rid of is called the idiosyncratic, non-systematic risk. You can get rid of some of the risk. So maybe that isn't the right measure of risk. So maybe we should just measure systematic risk. So systematic risk is beta. It's a measure of systematic risk. So now we're going to move into this idea. The systematic risk principle states that the expected return on a risky asset depends only on that asset's systematic risk. So you shouldn't get rewarded for bearing total risk, but rather finance says you should get rewarded just for bearing systematic risk. And so if we're going to get rewarded on it, we're going to need to measure it somehow, and we're going to use that beta, the amount of systematic risk present in a particular asset relative to that in an average risky asset. So what does beta tell us? If your beta is 1, it says we have the same systematic risk as the overall market. A beta less than 1 has less systematic risk to the overall market, and a beta greater than 1 has more systematic risk. So you could play around with these, look at a couple companies, see what their beta is, and see if you can understand the intuition as to why they may be more or less or about equally sensitive to the overall market. So let's look at the following information. Which security has more total risk? Well, that would be stock B because standard deviation is a measure of total risk. However, which one has more systematic risk? Stock C has more systematic risk because beta measures systematic risk. So the idea is which security should have a higher expected return? Well, since we can eliminate some of total risk by diversification, finance says we shouldn't get an expected return for bearing total risk, but rather we should be getting return based on how much systematic risk we measure. So according to the systematic risk principle, we should have a higher expected return on C because this total risk of 30% on B is not really relevant to arguing because you can get rid of some of that risk just by holding more assets in your portfolio. So let's look at this. The portfolio beta subscript P for portfolio is just going to be the sum of the weights of an asset times the betas of those assets. So let's do that. If we have a weight of 13.3 and a beta of 2.685, add that to the next. 20% weight has a beta of spot 195. C has a weight in the portfolio of 267 times 2 spot 161, and 40% of the portfolio has a beta of 2 spot 434. So if you did the math correctly, the beta of your portfolio is 1 spot 947. One thing to note and one thing to remember is the beta of the market is 1. The beta of the risk-free asset is 0. It has no systematic risk. It is free of risk, hence the word risk-free asset. It has no total risk. It has no systematic risk in theory. So that leads us to the SML, the security market line, in the title of this chapter, a positively sloped line displaying the relationship between expected return and beta. So here's our market beta of 1. Let's assume the risk-free rate is 8%. Market beta is 1. The expected return on the market is not 1. The expected return on the market would be over here. The expected return on asset A is 16.4%. So that's somewhere over here. And a beta of 1.2. So this security market line says that all assets should plot on this line. That the portfolio expected return and beta, all securities should be plotted on this line or they would be priced incorrectly. So the market risk premium is the slope of this line. It's the difference between the expected return on a market portfolio and the risk-free rate. If markets are well functioning, this ratio is the same for every asset. So as a result, when asset expected returns are plotted against asset betas, all assets plot on the same straight line, this line that we call the security market line. This, don't get confused with the other line you've seen in diversification that has all these assets plotted inside this investment frontier. This theory is stating that we should all see assets plot on this line, that their beta determines what expected return we should see. And if they were not on this line, those would be attractive investment opportunities for investors that would rapidly buy or sell this security until its expected return is driven back on the line. So in a well-functioning market, or what we say market equilibrium, that the reward to risk ratio here, the expected return, the slopes should match. So notice this term on this side, beta is just 1. So this would just reduce to the expected return on the market less the risk-free rate, and that's your market risk premium. If you remember this idea of a market risk premium of a risk premium before, it's an expected return less a risk-free rate. Well, the market risk premium is just the expected return on the market less the risk-free rate. And that's over 1 because its beta is 1. So let's say you observe the following in the market. C is plotting above. That means it's offering more expected return for its level of risk. If it's plotting above the SML, that's an undervalued security. That's attractive. You have purchased that. That buying pressure on C's price will lower its expected return because its price is being driven up and up by demand for it. So that buying pressure would continue, the price would go up, and as the price comes up, the expected return is being driven down. That expected return is going to keep getting driven down until it plots back on the line. So it's undervalued. You would buy that security. What would you do if you observe D? Well, that is below the SML. That is an overvalued security. Ideally, you could short that, use the proceeds from that short to buy C, and then with yourself, you could just hopefully have enough buying pressure on it that you could drive these prices back into market equilibrium. Since D is under the SML, it's an overvalued security, so you would short that or sell that security. The selling pressure on that drops the price. The lower price implies a higher expected return. So as you sell that security, its expected return is driven up and up, and D will plot back on that line. So this leads us to the idea of the capital asset pricing model, or the CAPM. It's the equation of the security market line showing the relationship between expected return and beta. It's read as the expected return of asset I is equal to the risk-free rate with beta times the market risk premium. This whole term in hard brackets here is also called the market risk premium. So it's just the slope of a line. Y equals mx plus b. So what does it show? Why is this so appealing to professionals? Well, the CAPM dissects the return of any asset, any individual asset, any company, Procter and Gamble, Coca-Cola, Berkshire Hathaway, whatever have you, should be determined as one, the pure time value of money. This is just a reward for being patient for your money, just the risk-free rate. You should at least get the risk-free rate because you're bearing risk, you should get something on top of that. You should get a reward for bearing systematic risk as measured by the market risk premium, this term here. That's the reward you should earn for bearing systematic risk. Then, lastly, the piece we have not talked about yet is the amount of systematic risk as measured by beta of that asset, and it's beta specific to that asset. So take a look. Again, the CAPM shows the expected return on asset I depends on three things. The first is the time value of money measured by the risk-free rate. Just being patient for your money, you should get a return that has no risk associated with it. Then a reward for bearing systematic risk, the market risk premium. That's the second piece there in hard brackets. And then lastly, the amount of systematic risk that's present in that particular asset. Notice that subscript for the expected return of that asset matches the subscript on beta. So what you're saying is the expected return of Berkshire Hathaway depends on Berkshire Hathaway's beta. So let's take a look at an example of how the CAPM can be used. The stock of AK Steel has a beta of 3.56. The expected return on the market is 10. That's ERM. So that's this piece, the expected return on the market. And the risk-free rate is 4%. That's here and here. So just be careful as you fill these in. So you take the risk-free rate with beta of 356 times the expected return on the market less the risk-free rate. A common mistake is for students to go too quickly and confuse the market risk premium with the expected return on the market. But this whole term in hard brackets is called the market risk premium. What's inside of it is the expected return on the market less the risk-free rate. Don't forget what a risk premium is. A risk premium is an expected return minus a risk-free rate. So let's take a look at another one. It's Tugboat Company here. We have the expected return on Urger's Tugboat here is the risk-free rate with beta of U times the market risk premium, which the market risk premium is the expected return on the market less the risk-free rate. So it has an expected return of 10.375% is equal to the risk-free rate of spot 0.35% with beta times the expected return on the market of 0.09 less 0.035. So all you have to do is just do some algebra here, 10.375 less the risk-free rate. That would be the risk premium there for Urger over the market risk premium of 9% less 3.5% equals beta. And you should get beta of 1.25. So the capital asset pricing line, if the risk-free rate is 3 and the expected return of the market is 11, use CAPM to calculate the expected return on asset X and asset Y. So if you do this correctly, you just are plotting the expected returns, assuming they fall on the SML, which is consistent with the systematic risk principle. Here's your expected return on the market. Here's your beta of Y. Here's your beta of X. And here are their respective expected returns. So let's say in the previous example, you observe another asset A with a beta of 1.4, an expected return of 16, and asset B, beta B of half, an expected return of 5. Since the slope of the SML is always the market risk premium, which is 8, and you can get that, it's shown here, your beta of the market is 1, right? So your expected return on the market is 11. The risk-free rate is 3. So the market risk premium is just 11% minus 3% is 8%. So the slope of this line is 8%. So if your beta was 2, then there you go. So in this case, the slope of the SML is 8%. We know the market to risk ratio is 8 per unit of risk. Find the reward to risk ratio for this asset. So for asset A, so risk here is measured as beta. You just take the expected return of 16%, spot 16, minus the risk-free rate of 3. You take 13 over its beta. I'll put subscript A here on reward to risk of A is 1.4. So all you do is take the 13% over the 1.4 and you get 9.3%. That is a reward to risk ratio, a slope that is higher than 8%. Therefore, it's attractive, it's undervalued. You would purchase that security in the marketplace. That purchasing power drives price up and it drives expected return down. It will drive the slope back down until you're plotted on the SML and the slope is back to 8. So we could do this process again for asset B. So asset B has a beta of 0.5 and expected return of 5. So the reward to risk of B is just the expected return of 5% less the risk-free rate of 3%. So you have 2% over 0.5, which is just 1. Oh my gosh, sorry. You have 2% over 0.5, which is 4%. 4%. It's less than 8. That's undervalued. Overvalued, I mean, that's unattractive, overpriced. It's not offering enough reward for its risk. You should be getting more. That's a security you would short or you would sell. That buying pressure would drive the price down. As the price goes down, its expected return drives up until we see a reward to risk ratio moving from 4 to 8%. So let's assume the risk-free rate is 4.8% and the market rate of return is 11.6. Label each stock as underpriced, overpriced, or correctly priced according to the CAPM. So here's what I like to do on these. You could calculate as the reward to risk ratio like we did before, but you could just make this new column say according to CAPM what the expected return for the asset should be. So I'll just put the CAPM here again. The expected return on asset I is the risk-free rate with its beta I times the market risk premium, which is just the expected return on the market less the risk-free rate. So all you need to do for the first case is the expected return on A, E of RA is equal to the risk-free rate, spot 0.48 with beta of 0.78 times the market risk premium. So all you do, since the market risk premium will stay the same, it's 11.6 last spot 0.48. Your market risk premium is 6.8%. Just multiply this. Remember the term in hard brackets is the market risk premium. So you just take the 0.68 times its beta, spot 7.8 with spot 0.48 is 10%. So the CAPM says the expected return on this security should be 10%. However, you notice it's trading at 11%. So its price must be too low because its expected return is too high. So you would buy that piece. It's undervalued. You buy that financial security. It's undervalued. Its expected return is too high according to the CAPM. The CAPM says this security should only offer an expected return of 10. You've discovered an underpriced security. Its price is too low. You would buy that security, continue to do so. That buying pressure would drive the price up. And as the price increases, the expected return will come down. Let's do the next one. That was a fun one. So we'll do the expected return. This time for B is the risk-free rate still. The reward for waiting for money plus the beta of 108 times the market risk premium of 0.068. So we take that spot 0.68 times 108 beta, then add the risk-free rate of 4.8% and you get 12.14. The CAPM says to hold this security, an investor should require or expect a return of 12.14%. This is only offering 11.88%. That's overvalued. That's priced too high. It's an overvalued security. You would sell that security. And let's look at the last one, the expected return. Again, I'm just going to plug in here. The CAPM is the risk-free rate with beta of C times the market risk premium. Remember, that's the term in hard brackets. So your expected return on C is the risk-free rate of 0.48 with beta of 1.40 times the market risk premium, which we calculated above. So you take the spot 0.68 in brackets times the 1.4 beta with the spot 0.48 risk-free rate, and you get 14.32. That is a correctly priced security according to the CAPM. You've observed in the marketplace it returning 14.32% return in expectation, and that's exactly as the market. That's exactly equivalent with what the CAPM predicts. So that security plots on the SML on the security market line. So one thing to remember here, I just want to write the CAPM again. The expected return on asset I is the risk-free rate with the beta of that asset times the expected return on the market minus the risk-free rate. And again, just remember, you could bring the risk-free rate to the left-hand side and say the risk premium of an asset is equal to the beta of its asset times this whole term, the market risk premium. This term on the left-hand side, when you subtract the risk-free rate, is called the risk premium of your asset, risk premium of asset I. All right, well, thanks for joining this video. It sure was a long one, but I hope you learned something new. Take care, scholars.